to take care of that. So yes, the next exam will be Wednesday. As I said, you should receive an announcement today, which I always send you, usually one on Monday, explaining what's going to happen this week, and I'm just going to explain what's going to happen for the rest of the semester. Since there's really not much time left in the semester, we're at the very end. So please finish strong. I know you can, but we need to make sure that we're going to finish strong here for the last pretty much, it's been about 3 weeks left. This week, next week, we'll have test 3, and then the week after is the final exam. So it's kind of what's happening moving forward. All right, are there any questions? All right, if not, let's start with today's discussion. So last week, we talked about aggregate demand and aggregate supply. So we talked about the model. So we set up the model and how it works. We talked about how the economy self-regulates, how things get back to normal. What we're going to talk about today is we're going to talk really, this chapter we can really just call government intervention. And we're going to talk about it through 2 mechanisms: monetary policy and fiscal policy. So if you look on Google Classroom, I split the slides up to monetary policy issues and fiscal policy issues. So that's really what we're going to spend this week talking about, is monetary and fiscal policy issues. And how does the government intervene, and why does the government intervene, and what are some of the drawbacks? So what this chapter focuses on, at least when we talk about the monetary policy, is we're going to talk a lot about the interest rate effect. So when we talk about monetary policy, we're going to focus on the interest rates. So pretty much we're going to look at money supply and how does the interest rates drive money supply, money demand, and also how does it affect aggregate demand. Now we're going to look at how does it use monetary policy to shift the AD curve. We'll talk about fiscal policy, and then we'll talk about whether we should use it or not. Okay. So whether we're for or against, what are some of the arguments economists use for stabilizing the economy, and what are some of the arguments of why we shouldn't do it? All right, so quick definition of what's monetary policy and what's fiscal policy. So when we think of monetary policy in the United States, this is the Federal Reserve. So the United States, the Federal Reserve controls the money supply. So they're responsible for discussing or setting the money supply. We're going to talk about how that affects interest rates. On the other side here, we have fiscal policy. And fiscal policy is set by Congress and then signed into law by the president. So when we think of monetary policy, you should be thinking about the Federal Reserve. When we talk about fiscal policy, you should be thinking about Congress and the president. And you should be thinking about 2 levers: government spending and taxation. So if I think about fiscal policy, what you should say is, ooh, we're going to change either government spending or taxation. If I say monetary policy, you should be thinking about, oh, we're going to change the supply of money. So we've already talked about who's in charge of those things. So now let's go through and let's discuss how these things work. So we're going to set up what I call kind of the guidelines. So if I learn nothing else in this chapter, I may forget everything else. But these should be the guidelines that we use when we think about monetary policy. So we call it loose monetary policy. or I'm increasing the money supply. When I increase the money supply, I increase aggregate demand. Tight money supply is the opposite. I decrease the money supply, I decrease aggregate demand. So when they talk about money supply, loose is an increase, tight is a decrease. Okay, so these are like the guidelines. So when we talk about this, always think, okay, if he increased the money supply, I need to make sure aggregate demand is going to increase. If he decreases the money supply, I need to make sure aggregate demand decreases. So just like we have tight and loose for monetary policy, for fiscal policy, we have expansionary and contractionary. So these are these guidelines. Mostly, so when we talk about fiscal policy, most of the time, we're going to talk about how fiscal policy affects aggregate demand. And then remember, when we talk about fiscal policy, it's 1, 2, government spending, taxation. So if I want to expand aggregate demand, so I'm going to do expansionary fiscal policy, I want to increase it. I'm going to increase G or decrease T. And here when we talk about taxes, we're going to focus on taxes by the consumer. And contractionary is just the opposite. I decrease G, increase T. So my kind of idea behind this is make sure, if you get nothing else out of these chapters, make sure you understand these relationships. Because on the test or on the quizzes, understanding these relationships, you can probably sometimes just guess the right answer, what to do. If I know I'm going to expand the economy, I want to increase aggregate demand, I can remember what to do. Increase aggregate demand. Oh, that means I either increase G, decrease taxes, or increase the money supply. And then I have to figure out whether I want to do fiscal or monetary policy, who's in charge. So that's kind of the very basics of what we need to do to stabilize the economy. Okay. Well, of course, we want to be a little more detailed besides just some kind of quick guidelines of what to do. We want to talk about why does this work and what's the ideas behind it. We'll also talk a little bit about how fiscal policy can affect some of the aggregate supply issues. And this is usually done through taxation and business taxation rather than consumer taxation. So quick reminder, right? Aggregate demand, we have the 3 effects why it slopes downward. We talked a little bit last week about which one's the most important, the interest rate effect. So what we're going to do then is we're going to focus on how does this interest rate effect come to be and how do we utilize it and take advantage of it. So the idea speculated by Keynes is called the theory of liquidity preferences. Oops. Okay. So the theory of liquidity preferences, just like always, we have money supply and money demanded. And what we're going to have here is the price. And the price here is going to be the interest rate. Nothing kind of groundbreaking here. What's groundbreaking here is that the nominal and the interest rate, real interest rate, are going to move the same way in the same direction. And the only way that occurs, if you remember back, is we expect the rate of inflation to remain constant. So if we expect the rate of inflation to be 2%, the nominal and real will move together because the expectation hasn't changed. And this can be true in the short run, that we don't think inflation will change in the short run, so we hold true with that idea. Also remember from previously, the money supply is fixed. Right? The central bank decides the money supply, and then once they decide the money supply, the interest rate responds to the money supply. The money supply does not respond to the interest rate. Okay, so money supply drives the interest rate. The interest rate does not affect the money supply. So it's only a one-way relationship. And because it's a one-way relationship, the money supply is going to be a vertical line. So money demanded is how much money I hold. Okay. So we're going to here assume for simplicity, I can only hold my money in two options. I can either hold it as cash or I can hold it as bonds. And so if I hold it as cash, I get no interest. If I hold it as bonds, it's going to give me some interest. So I'm going to get some return for my money. And I'm going to hold money because I want to buy goods and services. So we talked about before, MS is vertical, MD is typically downward sloping. Just like before, we find where they meet instead of this being the value of money, which is what it was in a previous chapter. Because it's the short run, we now refer to it as the interest rate. So we know it's the short run because the Y variable is the interest rate rather than the value of money. So when we talk about this monetary policy, we're going to talk about how the Fed changes it. We're going to talk about how they use it to shift aggregate demand. The most popular way they do it is they change the money supply. And when they do that, the interest rate that changes is something referred to as the Fed funds rate. And by definition, the Fed funds rate is the rate at which banks charge for short-term loans, usually to other banks. But based on the Fed funds rate, it affects all interest rates. So if the Fed funds rate is 0.25, well, that might mean that 15-year mortgages are 3%, 30 years are 4%. However, if the fixed funds rate were to go up to say 1.25, the other interest rates move accordingly. So when we talk about them changing the interest rate, in reality, the only interest rate they target is the Fed funds rate. But the Fed fund rate kind of serves as the goalpost for everything else. So if we move the Fed funds rate up, all the other interest rates move accordingly. Hence, if we move the Fed funds rate down, all the other interest rates move down. And the Fed targets its Fed funds rate through open market operations. Remember, that is the buying and selling of bonds. So let's look at a simple example here. Usually I increase the money supply, but here I'm going to reduce it. So what happens when I reduce the money supply? Well, when I reduce the money supply, interest rates rise. And because interest rates rise, it reduces the quantity of goods and services demanded. So what does it decrease? Well, it decreases both investment and consumption. Most students have no problem figuring out investment, right? Businesses are going to build new factories based on the interest rate. The interest rate is high. Businesses aren't going to borrow the money to build a new factory. But what about consumption? Well, what I typically ask students is how many of you have a car loan? Well, if you have a car loan, what's driving your loan is the interest rate. So as the interest rate would to rise, your loan payment will go up. And if your loan payment goes up, you may or may not be able to afford to buy a new car or to buy a used car. So what happens as interest rates rise, it rises not only loans given for investment, but also loans that we borrow for consumption. So the most popular one is a car loan. So yes, they might have the goal of an interest rate target. In fact, they do. And it's not as easy as we make it in class. In class, we go, oh, boom, boom. I can just draw the graph, make the interest rate be what I want. Oh, I'm at 1%. In reality, these things aren't stationary. Because remember, the money supply is driven by the actions of a bank and consumers. Because remember, when we talk about the money supply, we talked about how there's this money multiplier. Even though the Fed can push money into the economy, right? It can buy bonds. It doesn't mean that the banks will sufficiently lend out all of that, right? They might have more excess reserves than the Federal Reserve wants. The answer to your question, Francisco, is no. Mortgages are not considered consumption. Mortgages would be tied to investment because remember, part of the investment category is residential. So that's why I used car loans. So because, as I talked about before, because these banks can decide actually what the set money supply is, it becomes difficult for the Fed to get that interest rate exactly where they want. And because of this, it leads to sometimes fluctuations in the interest rate. And because the interest rates change, so does aggregate demand and output. That's sometimes why you'll see mortgage rates will kind of bounce around a little bit and the Fed didn't change the interest rates. It's because of this MS variable not settling nice and neat. Is that it's changing. I said in class, everything is stationary, but in the reality, things change every day. So in reality, what's equilibrium today may or may not be what's equilibrium tomorrow, because remember, we have millions upon millions of people interacting and making decisions. So that's the problem with prices, is they're going to change because people are changing supply and demand all the time. And because of that, interest rates will change. So most of the time, there is a Fed policy, is they shoot for a Fed funds rate. So when they talk about monetary policy, at least in the United States, most of the time they talk either about what they do with the money supply, or more often they talk about what they're doing with the interest rate. So the Fed says, oh, we're lowering the interest rate by 25 basis points, or they're going to lower the interest rates by 0.25%. Well, what they're going to do is they're going to increase the money supply, right? They want the Fed fund rate was 0.5, now they want it to be 0.25. So usually what happens is they talk about decreasing the interest rate. Rarely do they talk about, oh, the Fed's going to buy bonds, to increase the money supply. But as students of economics, you can sometimes decode what's happening. So when they talk about lowering the interest rates, you now know how they're lowering the interest rates and what the graph is looking like. All right, so here's kind of some real life examples of what's going to happen or how we're going to use this monetary policy. So here are 3 events, and what we're going to talk about are what's going to happen on the output. Okay, so when I have this thing occur, so when A occurs, what happens to the output? So based on this, what happens to the output, what should the Fed do to stabilize output? So we talk about stabilizing output. What we want to do is we want to move to the long run, or we want to move to potential GDP. So the Fed's goal is to move the economy back where it's on the long run aggregate supply curve, or where it's at its potential GDP, its full employment GDP. Remember, we had a bunch of terms for that. So when you're thinking about this, okay, what's going to happen when this shock or event occurs, and what's the Fed going to do in response? So here's question A. Congress tries to balance the budget by cutting government spending. So first thing you happen is what happens to aggregate demand or aggregate supply, and then what's the Fed going to do? Point B, stock market boom increases household wealth. And C, war breaks out in the Middle East, causing oil prices to soar. So let's go through these. A, Congress tries to balance the budget by cutting government spending. So we know by decreasing G, you know from chapter 20, that decreases aggregate demand. And when I decrease aggregate demand, output falls, so does the price level. So if I know output's falling, what should the Fed do to stabilize the economy? Well, what the Fed's going to want to do is they're going to want to move Y up. And how do they increase output? Is they engage in loose monetary policy. So they're going to increase the money supply. What the graphs look like. So here's the MS, MD. All right, so the easiest way is we start in equilibrium. Then the event occurs, right? Is we try to balance by budget by decreasing government spending. So what happens is aggregate demand moves left. So what do we notice? Well, we notice that we're short, right? Is that we're short output. Okay, we refer to this shortage, right, as a recessionary gap. So since we're stuck in this recessionary gap, the Fed doesn't want to be in a recession. So if the Fed doesn't want to be in a recession, what does it have to do? Well, it has to get us back to the long run aggregate supply curve. And so it has two options. It can do nothing and watch the economy fix itself. And that means the economy moves to point C. However, most of the time we're impatient. And we want the problem fixed now. So how does the Fed fix the problem now? Well, what it does is it's going to have to shift aggregate demand. And it's going to do that by moving us from point B to point A. So it's going to try to shift aggregate demand to the right. And how does it do that? And it does that by increasing the money supply. So it's going to increase the money supply. The interest rates fall. And when the interest rates fall, investment and consumption rise, as does aggregate demand. What about the other one? So what about a stock market boom? Well, here, stock market boom, right? That shifts aggregate demand to the right. And here, output increases, and that's this price level. Output is above the natural rate. And because it's above the natural rate, what the Fed wants to do is reduce MS and reduce aggregate demand back to normal. So let's start with where we are originally. So everything's in balance. What happens first is stock market boom. We shift right. And what we notice here, right? So here we have this other gap. And since this gap is to the right of the natural output, we refer to this as an inflationary gap. Okay, we almost have too much output as the economy is running too fast. So we have to slow it down to maintain its pace. Because remember, in the long run, we're running a marathon. We don't want to be sprinting in the middle of a marathon. So what we want to do is we want to slow the economy back down. And how it does that is it decreases the money supply. And what that does is it increases the interest rate, and when that does, investment and consumption both fall. And it usually does this when we're worried about inflation. And it's usually the term inflationary gap, is we're worried about too much inflation. The economy is running what they call too hot. And because the economy is running too hot, they attempt to adjust it to get it back to running normal. Now, finally, C. So war breaks out in the Middle East, causing oil prices to soar. What happens here is something unique. Here, what happens is the short run aggregate supply curve moves. And when the short run aggregate supply curve moves, it moves to the left. And so what happens here is actually kind of something weird. The Fed's left with two choices. So MS, MD. So what happens here, right? Short run aggregate supply moves left, right? We talked about this being stagflation. So what happens here is we have high inflation and high unemployment. And low growth or low GDP. So the Fed is left kind of between a rock and a hard place. If our goal is to stabilize output, then they're left with no choice. Then the Fed is going to have to increase aggregate demand to get us back to equilibrium. However, what that does is that really causes an inflation problem. The other way it could do it is it could try to slow down prices and get us back to the original price point, but that comes with decreasing output or increasing unemployment even more. So there's a problem when we have this short run aggregate supply shift, is there's not really an answer for the Fed. The Fed doesn't have the tools to answer the short run aggregate supply shift. It can't alleviate that problem. And in fact, it can only really make it worse, either through higher inflation or higher unemployment, and we need neither. So it's kind of stuck between a rock and a hard place there. So what are some of the problems or issues with monetary policy? The first issue with monetary policy is something economists refer to as a liquidity trap. So what is a liquidity trap? A liquidity trap is, there's a couple of issues here. There's a couple of ways to describe it. The first one is you do it from an interest rate discussion. So if you think about it, how low can I get interest rates? Well, interest rates can only go to 0. Why not negative? Why can't interest rates be negative? Because what does negative interest rate imply? Negative interest rates imply I give the banks $100, it gives me back 95. How many of you are willing to do that with your money? To give the bank 100 and to only give you back 95? Well, very few of you. Why would you not do that? Well, because if I kept the money myself, I keep 100. So I don't lose the $5, so I'll just keep it myself. So there's what they call a zero bound to the interest rates, because the interest rates can only go down so far. So they're often worried about that right now during the last recession. How far can the interest rates go? Pretty much they're stuck at 0. So even if I can't increase the money supply to get lower and lower interest rates. And so monetary policy ceases to be effective. And this is because I can't get the interest rates to fall, or even if I could get them to fall. In order for monetary policy to work, what has to occur? I mostly have to get investment from businesses. And why do businesses invest? The major reason businesses invest is future profitability. So what might happen is, especially in times of depression, is businesses might look around and say, there's not an opportunity for me to become more profitable. I don't see a path forward for more profitability. So if I don't see a path forward, I'm not going to borrow the money, right? So we have here the money or the resources that the businesses are going to borrow for investment. But if the businesses say, well, there's no future profitability, then I have no need for this money. And so what happens is this money sits in the bank and doesn't do anything. So we refer to it as trapped. So the liquidity trap talks about that there's some limitations to Fed policy. Because the Fed doesn't make loans to businesses, banks do. And banks just can't say, here, you must take a loan from us and pay us interest. It's not how the world works. So because of that, it's possible for money to be trapped in the bank. So here was issue 2. Part of it, we talked about the animal spirits. We can, as I said, we can have low interest rates, but nobody still wants to invest. Another issue is stabilization. It's probably the biggest. So I like to talk about it with a cartoon. So we have the kind of little Paul Revere guy walks around and says, the recession is coming. The recession is here. The recession is over. Why? Because usually they take about 11 months. Oh, now finally Congress got together and says, oh, wait, I have a stimulus bill. Again, the comment is, as soon as we can agree on the details. So often what happens is 1, 2, 3, by the time Congress acts, sometimes more than 11 months later, the recession is done. So we refer to these problems as lags. So you can kind of see the fiscal policy lag, right? It takes a while for our government to get things done. It doesn't matter, as I said, what party you're on. We all believe that. The government doesn't work fast enough for us. That's not usually the problem with monetary policy. The Fed is usually quick. The Fed is quick. They can change the interest rates quick. It doesn't take them long to change the interest rates, probably about 2 months. Because remember, they meet every 6 weeks, and boy, they can get things moving along quickly. Boom, 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 the Fed's got the interest rates changed. But the problem with the Fed, we talk about it, really it's a firm decision. Just because the Fed changed the interest rate, it doesn't change the investment plans. And because of that, it takes a long time. Not because the Fed didn't do its job, but since the Fed can't force people to take investments, take loans, it's going to take a while. So it can be done quickly, and it often is. The Fed often responds very quickly to recessionary conditions. The problem is the firms don't. I said it's going to take a while before they magically make an investment. It's like people just all of a sudden go, I think I'm going to buy a house today. Well, maybe some of you do, but most people don't. They just don't go wake up this morning and say, I think today's the day to buy the house. The interest rate went down. It's house buying day. No, it's a major purchase. You just don't usually get up in the morning and go, I think I'm going to buy a house today. And just go a realtor, all of a sudden, boom, you have a house. No, most of the time you have to go to the bank. You have to get out loan paperwork. You have to do all of this before you can get to buy a house. It doesn't happen instantaneously. Same thing works for businesses. They don't instantaneously say, I think I'm going to build a factory today. No, they make plans in advance, and it takes time. And so when interest rates change, bank individuals as well as firms have to go back and look at their plans and go, oh, is it time now with the interest rates falling to maybe make an investment? And this usually takes a good time after the interest rates have fallen before this goes into an effect. Just because the interest rates fall, as I said, doesn't mean it's an instantaneous change. All right, are there any questions about monetary policy?